Ever wondered how Forex trading works? Forex, short for foreign exchange, is essentially a global marketplace for trading national currencies against one another. Picture a bustling bazaar, but instead of fruits, spices, and textiles, the stalls are brimming with currencies from all over the world. The British pound, the Japanese yen, the euro, the US dollar, you name it. It's a colorful and diverse marketplace, and it's open for business 24 hours a day, 5 days a week. Why? Because when it's nighttime in New York, it's daytime in Tokyo and Sydney. This global nature of Forex trading ensures that the market never sleeps. Think of Forex trading as a giant seesaw. On one end you've got one currency, and on the other end another currency. The value of these currencies constantly fluctuates based on a myriad of factors, from economic indicators to geopolitical events. As a Forex trader, your job is to predict these fluctuations and make trades accordingly. Imagine you're holding a fistful of US dollars and you believe that the euro is about to strengthen against the dollar. So you trade your dollars for euros. If your prediction comes true and the euro does indeed strengthen, you can then trade those euros back for more dollars than you initially spent. That's how you make a profit in Forex trading. But remember, the Forex market is as vast as the ocean. It's the largest, most liquid market in the world, with an average daily trading volume exceeding $5 trillion. That's trillion with a T, folks. It's a market filled with opportunities, but also with risks, and it's crucial to navigate these waters with knowledge and caution. So, in a nutshell, Forex trading is all about buying and selling currencies. Now let's delve into the fascinating world of the Forex market. Imagine a bustling, vibrant marketplace buzzing with activity. But instead of stalls and vendors, you have banks, corporations, and individual traders, all participating in the largest and most liquid market in the world. That's the Forex market for you. Unlike the stock market or commodities exchange, the Forex market is decentralized. Now you might be wondering, what does that mean? Well, it means there's no central marketplace where transactions are carried out. Instead, all trades are conducted electronically over the counter, or OTC for short. This doesn't mean you're dealing with some shady back alley trades, though. It simply means that transactions happen via a network of computers spread around the world, not on a centralized exchange. This allows the Forex market to operate 24 hours a day, 5 days a week across different time zones. So whether you're an early bird or a night owl, the Forex market is always open for business. Now, who are the major players in this market? At the top of the food chain, we have the big banks and financial institutions. These guys are the market makers. They set the prices of the currencies. Then we have corporations who participate in the Forex market primarily for business reasons, say, to pay wages in another country or to pay for goods and services from overseas. And finally, we have individual traders like you and me who trade Forex with the aim of making a profit. So the Forex market is a bustling, vibrant place where currencies are traded. It's a global, decentralized marketplace where big banks, corporations, and individual traders all come together. And the best part? You can be a part of it too. But before you dive in, it's important to understand how the market works and how to navigate it. Next, let's talk about how you can get involved. So you're ready to dive into Forex trading, but what exactly will you be trading? Let's talk about currency pairs. The crux of Forex trading lies in the exchange of one currency for another, and these are what we call currency pairs. Picture this. You're at a foreign exchange counter at the airport. You hand over your US dollars and receive euros in return. In Forex terms, you have just traded the USD-EUR pair. In a currency pair, the first currency listed is the base currency. This is the currency you believe will change in value. The second currency is the quote currency. It's used as the reference point to calculate the value of the base currency. Let's take the pair EUR-USD as an example. Here the euro is the base currency and the US dollar is the quote currency. If the current exchange rate is 1.1, it means that 1 euro is worth 1.1 US dollars. But how does one make a profit in Forex trading? It's all about the fluctuating exchange rates. If you believe that the euro will increase in value against the US dollar, you would buy the EUR-USD pair. If the exchange rate rises, you would sell the pair, making a profit from the difference in value. Another commonly traded pair is the GBP-USD, where the British pound is the base currency and the US dollar is the quote currency. If you think the pound's value will decrease against the dollar, you would sell the GBP-USD pair. If the exchange rate drops, you could buy back the pair at a lower price, again making a profit from the difference. It's important to note that exchange rates are influenced by a multitude of factors, including economic indicators, geopolitical events, and market sentiment. So, staying informed is crucial for successful Forex trading. Understanding currency pairs is the key to successful Forex trading. But how do you actually make a trade? Let's find out. Now that you understand currency pairs, it's time to dive into the process of making a trade. First things first, you'll want to analyze the market. This involves studying economic, political, and social events that might affect the value of currencies. You could do this by reading financial news, looking at economic calendars, or even using technical analysis tools that help you study market trends. Once you've got a pretty good idea about the state of the market, you'll need to decide on a currency pair to trade. Remember our chat about currency pairs? You'll be buying one currency and selling another. So for example, you might decide to trade the US dollar against the euro, making the EUR-USD your chosen pair. Now comes the exciting part, placing your trade, but before you jump in, you'll need to decide whether you want to buy or sell. If you expect the base currency, that's the first one in the pair, so in our example, it's the euro. To rise against the second currency, you'll place a buy order. On the flip side, if you expect the base currency to fall, you'll place a sell order. So let's say you've read up on the economic news, and you think the euro is going to rise against the US dollar. You'll go to your trading platform, select the EUR-USD pair and place a buy order. And voila, you've made your first Forex trade. But here's a friendly reminder. Forex trading isn't a guaranteed way to make money. It's a form of investment, and like all investments, it comes with risks. You could end up losing some or even all of your investment, so it's important to trade responsibly and only invest what you can afford to lose. Now let's talk about risk. Forex trading can be exciting and profitable, but it's important to understand the risks. Let's start with market volatility. The Forex market is a wild beast, folks. It's constantly changing, influenced by a variety of factors from geopolitical events to economic data releases. This volatility can create opportunities for profit, but it also means the value of your investments can swing wildly in a short period of time. Then we have the risk of leverage. In Forex trading, leverage allows you to control a large amount of money with a small initial deposit. It's like a double-edged sword. It can amplify your profits, but it can also amplify your losses. In fact, you could lose more than your initial investment. Scary, right? Now don't let these risks scare you away. Instead, let them guide your journey to becoming a successful Forex trader. How, you ask? Through education, practice, and risk management strategies. Education is your compass in the world of Forex trading. It helps you understand the market, the forces that drive it, and the strategies to navigate it. So read up, attend webinars, and learn from the experts. Practice makes perfect, and in Forex trading, it could also save your wallet. Many brokers offer demo accounts where you can practice trading without risking real money. Use these accounts to hone your skills and strategies before diving into the real deal. Lastly, risk management strategies are your safety net. They include setting stop-loss orders to limit potential losses, diversifying your investments, and never investing more than you can afford to lose. Remember, even the most experienced traders can't predict the market with 100% accuracy. Remember, the key to success is knowledge, practice, and patience. Be sure to like, subscribe, and turn on the bell for the latest content. Until next time, keep mastering your money.